Well, good morning, everyone. I'm Robert Summercrast, Dean of the Terry College of Business, and I want to welcome everyone to this month's edition of Terry Third Thursday here at our Executive Education Center. If this is the first time that you've been to a Terry Third Thursday, and for some of you it's the first time you've been in the One Live Oak building where we have our Terry Executive Education Center, this is where we have our base of operations in Atlanta. So we run an executive MBA program here. Obviously, we have the speaker series and other events for alumni in the business community, some non-credit executive ed, and just a great way to connect with the business community. So let's move on to today's program. Just over a month ago, it was my pleasure to present the Terry College's highest alumni award to Bill Douglas, our Distinguished Alumni Award. And while I had the honor of presenting that award to Bill, it was really his peers, the fellow alumni from the Terry College, who selected Bill to receive that honor. Now let me put this award in context. Every year we have almost 2,000 graduates from the Terry College of Business. This year we had over 2,000 graduates. We have about 60,000, somewhat over 60,000 alumni from the Terry College, and from that group, we selected 3 for that honor. So this is indeed a very high award, and in my opinion, there wasn't a better choice than Bill for receiving that award. Bill was a 1983 accounting graduate and spent the first couple of his years of his career with Ernst & Winnie, but the bulk of his career, now going on 26 years, has been with various parts of Coca-Cola and its various companies. Beginning in 1985, he held various finance and international assignments with Coke, worked in Spain, Norway, England, and Greece. Prior to coming to Coca-Cola Enterprises, he served as CFO for Coca-Cola HBC, which is one of the largest bottlers in Europe, and it had a territory that encompassed 28 countries. In 4 years at Coca-Cola HBC, he led the acquisition of the Russian Coca-Cola franchise and the company's successful expansion into those regions. Bill joined the bottling side of Coca-Cola in 2004 when he was named the Principal Accounting Officer and Controller of Coca-Cola Enterprises. He was named CFO in 2005 and then added the title Executive Vice President in 2008. Since coming back to the States, Bill also reconnected with his alma mater in some very important ways. He is a UGA Foundation trustee and also a member of the Tull School of Accounting Advisory Board. He's also moved closer to Athens and now has a working farm in Bishop, Georgia. Over the past year, Bill and his management team were integral to the sale of Coca-Cola Enterprises North American business to the Coca-Cola Company and to the purchase of Coca-Cola's Norwegian and Swedish operations just last fall. So you can see he's got a very interesting and powerful career, and he certainly is a wonderful alumnus of the Terry College. Let me turn this over to Bill and let him tell his own story.
Good morning. Pleasure to be here. Several people asked me what I was going to talk about. I'm going to talk about something I know something about, which is the Coke system. And this is actually the 125th anniversary of Coke. It was physically on May 8th, a couple of weeks ago. But I'm going to try and explain a little bit about the history of the Coke system in North America, how the various aspects interact with each other. Some of you being Atlanta-based probably know that, but some of you may not fully understand it. And then explain a little bit about the transaction that we did and what the company that I work for now looks like. If there are any questions as we go along, please feel free to ask. I'd like it to be interactive. I'd like to recognize and thank Thomas Najjar, who's here with me today, helped put this together. He's actually a Clemson alum, which is great, but he was very paranoid about being here, but I told him everybody wasn't going to be a UGA alum, so if you're not a UGA alum, raise your hand. There you go, about half the crowd. Alabama doesn't count. So with that, I'd like to go ahead and open up. And as I mentioned, Coke was founded in 1886 by Dr. John Pemberton in downtown Atlanta. He was a pharmacist. And the product was originally a fountain drink served by soda jerks in pharmacies. And that's important because the Coca-Cola Company always retained the rights to the fountain post-mix business in the United States. At McDonald's, you would go to restaurants, cinemas. When you use the cup and get it out of the machine, that was always part of the Coca-Cola Company and not the bottling system. And that's important because that was one of the many factors that led to the transaction that we did last year. Then moving along, in 1894, Coca-Cola was first bottled actually in Vicksburg, Mississippi, which is going through a tough time right now, as we all know, with the floods. But it was an unauthorized bottling. Somebody said, this is a really neat idea. And a couple of gentlemen from Chattanooga, Tennessee went to the Coca-Cola Company in Atlanta and said, we'd like to really do this and put Coke in bottles. And the guys at the company at the time said, well, that's a dumb idea. Everybody wants to go to the pharmacy, have the experience, sit down at the soda fountain and get the drink and watch the guy make it. And they said, well, we think it's a really good idea. Let us give it a try. So they go back and forth over a period of months. And finally, they got the rights to bottle Coca-Cola in the entire United States for $1 because the company did not think it was going to work. But ultimately, over the next intervening 10, 20 years, these guys went out and, like multi-level marketing, they went out and recruited local business people in each community all over the country to have local Coke franchises underneath these two guys. And these two guys were just taking a cut of the pie. And ultimately, that intermediate master franchise was sold back to the Coca-Cola Company for hundreds of millions of dollars after they had made hundreds of millions of dollars. And that was in 1899 when they got that relationship. So the Coca-Cola system is comprised of the Coca-Cola Company and various bottling companies around the world. Now, the Coca-Cola Company is principally the brand owner. They're responsible for creating and maintaining the brands, doing all the advertising, and managing the bottling system. They also produce the secret formula. It's very concentrated, and then they ship it off to the bottlers who then do the manufacturing process. Now, that was the traditional relationship. And over the last 10 years, the Coca-Cola Company has actually become the largest single global bottler as they've bought back franchises, not with the intention of keeping them for extended periods of time, but kind of helping them through a transition to other ownership. The bottling system on the left-hand side of the chart, and in this case Coca-Cola Enterprises, is responsible for the production, distribution, the marketplace execution, the in-store up and down the street, Kroger, Publix, et cetera, and then the community and customer marketing. So when people are having a charity event and they want Coke at their event, they want somebody to give a donation, they call CCE. The Coca-Cola Company typically doesn't get that call. So looking at it a little bit more graphically, the Coca-Cola Company provides this concentrate, the secret ingredients, to the bottling system, and then we would procure all the other ingredients: water, carbonation, packaging principally is the biggest expense. And then in the United States, when we sold the business to the Coca-Cola Company, we had about 65 manufacturing facilities in the U.S. In Europe, we have 17. And then those bottling plants are very large, very sophisticated, $100 million type plants that make, it's all about scale. It's a very simple business. The complexity comes about only by scale. Then warehouse and transportation, then dealing with the points of distribution, including vending machines and other routes to market, and ultimately dealing with millions and millions of customers around the world. Talking about that aspect of scale, I think today almost 2 billion servings of Coke products are consumed daily around the world, just to put the magnitude in some kind of perspective. So again, I talk about the bottling system, and there are hundreds of bottlers around the world. But if you look at these top bottlers here, if you count the Coca-Cola Company and these other 4 key bottlers, it's almost 50% of the global volume. Not quite, but in that neighborhood. So you can see there is a lot of consolidation that's taken place. I'll start on the left with Coca-Cola FEMSA, which is based out of Mexico and is principally the key bottler in all of Latin America. They don't have all operations in every country, but that's their area of influence is Latin America. In the far right-hand side, the yellow, and that's lose it a little bit to scale, but that's the other Coke bottler that I work with, Coca-Cola Hellenic, which has operations from Ireland ranging all the way over to Russia and including Nigeria, believe it or not, which is a little bit of an outlier. Coca-Cola Amatil, bottom right-hand, is kind of Australasia. They're an Australian company, but they do have operations in other markets as well. And then we are in the little spotlight there. Our operations are exclusively Western Europe. Our corporate headquarters does remain here in Atlanta, but we have a few more than 100 people here. And then we have over 13,000 employees in England, France, Belgium, Netherlands, Norway, Sweden, and Luxembourg. And then, as I mentioned earlier, the Coca-Cola Company also has operations dotted around the world, but their principal bottling operation now is North America as a result of the transaction I'll discuss a little later. So Coca-Cola Enterprises, just a little bit of history here. I won't try and hit all of it, but it was actually formed in 1986 when the Coca-Cola Company made an initial public offering of what were then bottling operations that they owned in the U.S. So you can see the ownership structure has gone full circle. And at that time, CCE probably controlled about 20% of the manufacturing and distribution within the United States. Then over the coming next 20 years, CCE was an acquisition vehicle. They acquired a number of small bottlers and some medium-sized transactions in the U.S. They acquired Canada, and then in 1993 was the first European acquisition in the Netherlands, and then we bought those other countries that I mentioned earlier with the exception of Norway and Sweden over the next 6 years. So at its height, Coca-Cola Enterprises was responsible for 80% of the bottling and distribution in the United States, 100% in Canada, all of Western Europe, and we were responsible for about 20% of the Coca-Cola Company's global volume, and by far the largest bottler in the world. But things weren't working perfectly in all markets, and hence the title of my presentation, Sometimes Smaller Can Be Better. The marketplace was changing a lot. If you look in North America, there was a lot of challenges from a commodities perspective. Corn, which we use for sweetener, was being diverted from non-food uses to creating ethanol. So commodity prices were spiking really high. And then if you look at the way the system was put together, the fact that we had the bottling system doing bottle and can, the Coca-Cola Company doing fountain, and literally competing in the marketplace with each other. Think about going into a Quick Trip or a racetrack or some kind of large petrol or gas convenience store, and you walk in and you have a choice. Am I going to go over and spend 99 cents for a 32-ounce fountain drink with a big sign there, or am I going to go over here and pay $1.59 for a 20-ounce bottle? So we were competing with each other in the same store. Now, I think it's important to have both formats, but it wasn't being coordinated as well as it could be. So that was creating a lot of opportunities for a more efficient way to interact with customers and consumers in the U.S., notwithstanding while CCE owned 80% of the market, there were 70 other bottlers, by definition very small bottlers, did not have scale, that were responsible for the remaining 20% of the U.S. volume. However, our business in Europe was doing very well. We had all package formats. We had bottle can and the fountain. The route to market was very different. So the fact that the U.S. was the birthplace of the soft drink industry and was bound by its heritage had become a little bit of an anchor, whereas in Europe, the business really developed during World War II. It wasn't constrained by some of those heritage factors. So we announced the transaction February 25th, 2010. I think I'll remember that day as long as I'm alive, whereby the Coca-Cola Company would acquire the the North American bottling operations from CCE. CCE would reinvent itself as a European bottler, and as part of that, we would acquire bottling operations that the Coca-Cola Company owned in Norway and Sweden. And it was a very sophisticated, complex financial transaction of how we did it. The Coca-Cola Company prior to this owned 35% of our shares. So those shares were part of the consideration. The Coca-Cola Company assumed all of our debt as part of the transaction. So day one, we had zero debt. So we went in the marketplace and raised some more debt. And as part of the transaction, the old CCE shareholders received a new share in new European CCE plus $10 cash boot, if you will, for those tax people in the room. That was a very complex part of the process, by the way. I won't go down that rabbit hole. But anyway, prior to the deal being announced, our share price was $19. So this was effectively a 50% consideration in cash, and then the new share was going to be valued by the marketplace. So again, another graphic to kind of keep it simple. Old structure was the Coca-Cola Company owned, amongst other things, the bottling operations in Norway and Sweden, the 34% interest in CCE. CCE was basically a publicly traded company listed on the New York Stock Exchange, market cap well over $10 billion. And then we own North America and Europe, were subsidiaries, if you will, of corporate CCE. Then after the transaction, the Coca-Cola Company ended up owning 100% of the North American bottling operations that were previously owned by CCE. And then new CCE was 100% owned by public share owners. We actually issued a new share of stock, which had legal and tax important characteristics to it. And then we owned the old European operations plus Norway, Sweden. So it was a very compelling transaction for both Coca-Cola Enterprises and the Coca-Cola Company. It allowed CCE to continue focusing principally, or exclusively, I guess, on our Western European operations, which were very successful and arguably had a higher market valuation than our North American business. And it allowed the Coca-Cola Company to consolidate and take the North American business to greater heights. We were trying to do a lot of the things that the Coca-Cola Company has done and will continue to do in North America, but given that they are the franchisor and given the fact that they had those fountain business, which, to put it in perspective, the fountain business represents approximately 1/3 of all the product consumed in the U.S. So you can see the scale and the potential synergy opportunities of putting those two North American businesses together. That was something that the Coca-Cola Company was uniquely positioned to do, and CCE could never reap the benefits. So it was truly a win-win for both organizations. I think that's exemplified in a number of ways, but I think the most significant way is after the transaction. It was announced in February of last year. It was consummated on October 1. So we're now in May. So if I look May to May, after the transaction was announced, our share price is up over 100% since pre-announcement of the transaction, which is obviously a great return to share owners. But even after it got the initial bump, if I look 12 months out, our share price is up 50%, which is an outstanding return. But the Coca-Cola Company share price is up well over 30% as well. So it's a very unique transaction where both parties can get such a meaningful impact to their shareowners. And I think both parties are still very happy, and there's no buyer or seller remorse at this juncture. So it's quite a unique transaction that benefited everyone so successfully. So, hence my title, sometimes smaller can be better. So this is how we communicate with the investment community in New York. And these are some of the key financial metrics that we articulate as our company goals. On the left-hand side, it's old CCE, including North America and Europe. And you can see the size of the population, significantly smaller. Revenues, significantly smaller. But revenue growth, we had guidance of 4 to 5%, and with the new company, we actually increased that 4 to 6. And last year, we performed at the high end of that range. So a meaningful increase in revenue growth with the new company. And then operating income growth, even more meaningful, 5 to 6. And then the new company is 6 to 8. So hence the title. So what is CCE today? I've touched on this to some degree, but this is 2010 pro forma information, about $7 billion. Given the growth in our business and the strength of the euro versus the dollar, that number will be well over $8 billion, I would expect, in 2011. 125-year anniversary, 90 years in Europe. A number of brands, most of the brands that you would see in the U.S., but also some unique European brands as well. Over 13,000 employees, 17 manufacturing facilities, and we are serving 165 million consumers in the countries highlighted there. So one of the things that the current management team did about 5 years ago was come up with a vision about what our company was all about and an operating framework. And one thing that we are, I guess, proud of and has been successful is, even as a result of this transaction, how we were managing our business while we changed geographies, how we were managing our business, how we communicate to customers, and how we communicate with our employees did not change. So we're just doing the same thing with a slightly revised geography. But what we are all about is being the best beverage sales and customer service company. So we don't really just see ourselves competing in the soft drink arena, it's the beverage arena. And to be honest, it's really the fast-moving consumer goods arena as well. And we've got 3 key principles that we work against to achieve that. Number 1 or number 2, brand in every category in which we compete. Clearly, Coca-Cola, Diet Coke, Coke Zero are the leading brands within their segments. But we get deeper than that as well. The energy category, the water category, the juice category, the smoothie category, and maybe even categories that don't exist today. You think about 10 years ago, I don't think people were drinking energy drinks. So the beverage landscape is always changing, and we have to change with it. And that may mean buying brands or inventing new brands as the beverage market evolves. Most valued supplier. So as we deal with our customers, it is a complex supply chain network, starting with the Coca-Cola Company to the bottling system, to retailers, to the consumer interaction with the product. So the consumer store network is ultimately our route to consumers, and that is critical to our success. And then lastly, at the end of the day, it's all about people and the passion of our people, the capability of our people interacting with the market on literally a daily basis to allow around the world those 2 billion drinks to be consumed. So this is a little bit of financial information on the new CCE, and you can see here the operating income performance for 2005 to 2010. And you can see very consistent growth year over year, which is something that we pride ourselves on from a European perspective. The other thing I would highlight, and it really came out as we did this transaction and we're remarketing ourselves to investors and to Wall Street, and was a big part of the share price increase that I alluded to earlier, But you have to think about what the macroeconomic environment is in this period, 2008, 2009, and 2010, and to deliver operating income growth of this magnitude in that very negative economic environment. So our brands are not recession-proof, but as you can see, they are fairly recession-resistant. People spend 99 cents to buy a soft drink. They don't give it the same analytical thought that they do to go buy a car or a washing machine or a house or whatever. So these simple moments of pleasure actually help people get through tough times. On the flip side, when the economy's booming, we're not going to see a boom. People aren't going to drink twice as much Coke when they got twice as much money in their pocket. But I think all else, it is a very good business to be in good times and in bad times. One of the unique things that we marketed our story to investors from a European perspective is the opportunity for growth. You think about France, Great Britain, other Western European markets. You think about older population. You think about mature economies, which they are, but they're really not that developed from a commercial beverage and from a soft drink perspective as people might think. On average, our markets have about half the annual consumption of soft drinks that there are in North America. So part of its culture, part of its history. That's not to say that we're going to grow the European consumption habits to those of the U.S. anytime soon, but it gives us confidence that there is growth opportunities in what would otherwise be thought as fairly mature markets. Brand portfolio, similar to that in the U.S., but different in some respects as well. The Coke trademark brands, regular Coke, Coke Zero, and Diet Coke represent almost 70% of our sales in Western Europe, which is a lot. Those brands are still growing, believe it or not, and we clearly have opportunities for diversifying our portfolio and growing what we call still brands. You can see the brand lineup there. We do have energy drinks. We are the exclusive distributor of Monster in all of our markets. Also have Dr. Pepper, Capri Sun, which is not a Coke brand and not sold by the Coke system in North America. We do have in Western Europe, Vitamin Water, Minute Maid, and we have several water brands that are uniquely European brands that we distribute as well. So that's our current brand mix. These brands are growing low single digits, and then the still brands would be growing in the double-digit category. So the pie is shifting a little bit towards stills, but importantly, the overall pie is growing, and both sides of the pie are growing as well. From a competitive set perspective, the Western European market looks very, very different than it does in North America. Basically, in North America, you've got the Coca-Cola system with a 40-odd share. You've got Pepsi with a share of mid-30s. You've got private label, some water brands, and all other. But in Europe, much more fragmented, and the left-hand pie is volume. So irrespective of how the product is priced, you can see we have about a 20% share, and the Pepsi system has a 6% share. If you go over to value, we are clearly premium branded products. We price them accordingly. Our value share goes from volume of 20 to value of almost 30. And you can see the gap there versus the number 2 competitor, which is really good if you go in the marketplace. We have pricing leadership. We price our products to be premium, and then we let the rest of the market adapt and adopt to that. So the competitive set, very different in Europe than it is in North America. Customers, I talked about one of our clear objectives was to be our customers' most valued supplier. Well, I'm happy to report that we're generally achieving that result. Last year, 3 of the 4 key markets voted us the #1 supplier, and that's across all categories in the grocery channel. and then we were number 2 in France. Now, it's going to be difficult to be number 1 every year, year in and year out. We recognize that, but that is the aspiration that we're trying to live up to. I mentioned the 125th anniversary. We work really hard year in and year out to connect with consumers in a meaningful way. And everybody has different Coke moments depending on where they grew up, what their age is. But we try and create those moments even today. And I've been really pleased and surprised with how well the 125th year anniversary campaign has resonated with Western European consumers. Last year, it's not that big a deal in the U.S., but last year, all of our summer promotions were skewed around the World Cup. Soccer, or football as it's called in Europe, is like SEC football in the South. It's what everybody lives and breathes. So we knew that was going to be a very successful customer promotion last year. We were a little bit concerned about this year, but this promotion is turning out to be equally as successful. Next year, again, our operations are in England. We're going to be the host of the 2012 London Olympics. So clearly that's going to resonate very well with consumers in Great Britain as well as Western Europe, because people will be able to hop on a train and go see the Olympics if they so choose. And we'll be integrating a lot of things, whether it's carrying the Olympic torch and the torch relay, free tickets or whatever, a lot of ways to activate the Olympics in the markets, given that we're going to be the host country. One of the other things that's part of the fabric in everything that we do was corporate responsibility and sustainability. And that's being a good corporate citizen. I think it's important to note that we do that for 2 reasons. One, because it's the right thing to do. But 2, we are finding ways to do it in a way that actually improves our business. A lot of the things that we're doing with changing our lighting in our factories, going to vehicles that use alternative fuel, using less water in our plants, having zero waste coming out of our factories, ultimately all those things save us money as well. So it's the right thing to do, but it's also good business. Now, I'm not going to tell you every initiative that we do saves us money, but we are able to do it in a way that we think is very effective from a shareowner perspective, and obviously resonates very well with customers as well as consumers. I think this is the 3rd year we've actually been the #1 rated food and beverage company in the world in the CRS rankings by U.S. magazines. So that's something that we intend to continue. Ranked ahead of the Coca-Cola Company, PepsiCo, Kraft, any other food company around the world. And these are just some of the other recognitions that we have received. It's going to be a little more challenging, though, just being a European footprint, to see if that recognition continues, but we'll work hard to get the story out. People. I mentioned people. We have 13,500 employees. We had over 70,000 employees when we had the North American business. For those of you that ever have friends or neighbors that work for the Coca-Cola system, one of the secret ingredients is the passion that people have. I mean, it becomes, if I may say so, an addiction and a passion, and kind of subsumes your life. I've traveled all over the world. I lived in Europe for almost 15 years and had unique opportunities personally and professionally, and it's something that I'm extremely proud of. If you look at how we recruit people, there's kind of a breaking point. When people join, it's hard work, you're putting in your dues. Generally, our business is very physical. If you think about people that are delivering those trucks and delivering the product, it is hard work. And you have a lot of churn in that first 2-3 years. People say, this is not for me. They don't see a career path. But if somebody sticks with the business for about 4 years, there is a very high likelihood that they're going to stick for their career. And that's a rare thing today in the U.S. business world for people to stick with a company for, in my case, over 25 years. But clearly people are a very key ingredient to the ultimate success of Coca-Cola Enterprises as well as the Coca-Cola Company. This is our investor relations director, Thor's favorite chart, so we always have to use it. But as part of this transaction, we returned $3.8 billion to shareowners last October, which, again, I mentioned was about 50% of the share price prior to the announcement of the transaction. But importantly, it was more cash that had been returned to shareowners in the prior 20-odd year history of the company. So it was a very significant event. This is my favorite chart, which is the share price performance. And you can, if you run the math, prior to the announcement of the transaction, it's 100% or over 100% increase in the share price. And 12 months from yesterday, it was a 50% increase. But importantly, the Coca-Cola Company, while not quite as dramatic, experienced similar share price performance as well. Both of us significantly exceeding the overall market indices. So, looking ahead, we've announced, we are still listed on the New York Stock Exchange. We are still domiciled in the U.S., even though all of our operations are in Europe. We're doing a secondary listing very soon in Paris on the NYSE Euronext, which will allow us to get more exposure to European investors, given that we are a European operating company, and will continue to build the profile of our company and hopefully get bigger over time as well. So that's kind of the key points I wanted to raise. Not sure what our time is, Robert, but I'd be happy to take a few questions.
We are recording this. It'll be posted on our website as both audio and video. So if you have a question, I'd ask that you raise your hand. We'll bring a microphone to you. It also makes it easier for people to hear in the room, but it certainly gives us a chance to record the question as part of this presentation. So we have a few minutes for questions.
I've got a couple planted, so go ahead.
Hey, or Bill, you mentioned the effect of commodity prices. To what degree is that still happening today? Because it's in the news for sure. And maybe you can speak to currency valuation swings, the effect of that, and what you do to mitigate those.
I feel like I'm in an investor conference. Very good question. I'll start with currency. As I mentioned, all of our revenues are non-dollars. So about 50% is in euros, a little over a third, or 40% would be sterling, Great Britain, and then a little less than 10% Norway, Sweden. We do not hedge our revenue stream. So we are exposed to currency fluctuations. Fortunately, the dollar has been weakening since we announced this transaction, so it's been a positive thing. But over time, it will turn, and it is an issue of volatility that our dollar-based share price will be subject to. So we're very clear in explaining that to investors, and a number of investors may hedge the currency exposure on their own account, but we don't do it. We do hedge transaction exposure, which is a real physical exposure to currency. The best example would be in Great Britain, we may have some expenses that are euro-based, so we would hedge out that GB euro cross-currency exposure. With respect to commodities, that's one of the things that's really benefited our share price. In general, our competition in Western Europe is experiencing a commodity environment, inflation, cost of goods inflation of about 10%. We've said publicly that we expect our cost of goods to go up about 3% in 2011. So we are beating the market by a significant magnitude. Part of that's based on our diversity of supplier network, and part of it's based on a fairly sophisticated hedging policy and very good procurement specialists. We have somebody that specializes in sugar, aluminum, steel, PET, fuel, natural gas, and we are monitoring and taking actions to mitigate that at all times. Brantley?
Thank you, Bill. We love having you as our neighbor at Wildwood. But with all of your operations being in Europe, what's the long-term prospect for remaining in Atlanta?
Well, we've said that we envision maintaining a headquarters in Atlanta indefinitely. As I said, we only have a few more than 100 people based up at Wildwood. And most of those people are IT, and we're actually continuing to hire people in Atlanta. We're having a few people move over to Europe this summer, as you might expect, but our overall headcount is not increasing. As long as the tax laws are as they are, it is highly punitive for us to re-domicile. So for the foreseeable future, we envision maintaining a headquarters in Atlanta, as well as being principally listed on the New York Stock Exchange. Anybody else? Yes, sir. And then we'll go to you, ma'am.
You have a unique relationship with two public companies that are so intrinsically tied together, with you being the distribution arm of Coke products. But you mentioned that there are a number of products in the still space that are not Coke products, and I was wondering to what degree does Coke have influence or control over your ability to develop additional product or acquire additional product for distribution?
Very good question. Control zero. I mean, we are a completely independent company. There are a few things that are prohibited based on our agreement, our bottling agreement with them. We can't and would not want to ever do another cola, for example. But once you get out of that space, it's fairly flexible. Influence is a different answer. Clearly, they would like us to be their exclusive partner. And to be quite clear, we would like that as well. So every year or so, we do a survey of the beverage landscape, and we say, how are we positioned? What are the growth areas? Do we have the number one or strong number two brand in every one of these categories? If the answer is yes, we're good to go, and we keep on working. If we identify some voids, we sit down with the Coca-Cola Company and we say, there's an opportunity here in this area. Do you agree? Generally, the answer would be yes. How can we attack that opportunity together? And it may be going out and buying a brand. It may be creating a brand. If we're not able to do that, our last kind of default choice on a decision tree would to go out and look at a partnership with another franchisor. So again, to put it in perspective, over 90% of our volume are brands of the Coca-Cola Company. So while we do have some very important relationships outside of that, it's still a 90-10 relationship. Yes, ma'am.
Thank you for being here, and thank you to Coca-Cola and Coca-Cola Enterprises for being such a tremendous supporter of Atlanta. This is not a financial question, so I hope you'll forgive me. We're all very concerned about obesity levels in this country, and Coca-Cola has come under a certain amount of fire for carbonation, sugar, and so on that is included in the secret formula. I'm wondering what your latest strategies are to address that issue.
Sure, that's a very good question, a very fair question. And it's not just an issue in North America. It's an issue in Latin America. It's an issue in Western Europe. As I said earlier about passion, I feel very passionate about this conversation as well. About a third of, over a third of the volume that we sell are zero-calorie or low-calorie products. So it's something that we are committed to. But we're also committed to letting consumers make choice. So, for example, we no longer sell calorie soft drinks in schools. I will tell you, when we made that decision, schools were livid because it was a huge, huge source of revenue for extracurricular activities. So we cut off a huge income stream from them. But from a societal perspective, we thought it was the right thing to do. So we are committed to offering low-cal and no-cal products. We are committed to working with young people and working with schools for education about caloric intake and for education about getting up off your butt and going out and exercising. And we think it's important to educate people, to allow people to make choices, and to make sure that we're giving people a choice for no-cal or low-cal products. But at the end of the day, there is some parental responsibility and there is some consumer responsibility to consume things in moderation and to make sure that you're having a healthy and active lifestyle. So that's my personal feeling, and I think that's a corporate philosophy as well.
Hey, Bill. Kind of to piggyback on Harriet's question, you mentioned that stills were expected to double. And is that due to the nutritional focus of consumers, or is that expanding in terms of new product? Or
It's probably 2/3 expanding our offerings and 1/3 market movement, but it's principally we're underrepresented in that arena. So as we get more of an active player, we're growing off of a smaller base. But the market is not moving as fast as you might think it is. Maybe one more question. I really appreciate all the questions. I love answering questions. Yes, sir.
Yes, sir. First of all, thanks for being here once again. But I was just wondering, I understand the benefits of cross-listing stocks, maybe internationally, but why would you choose something maybe like Paris as opposed to London? Was there any significant influence in that decision?
Yes, very good question. So our shares, even European investors, they're going to principally buy our shares on the New York Stock Exchange. It's the largest, most efficient exchange in the world. But a number of European funds, they need to, quote, check a box and say that this company does have a European listing. So we were looking for a little bit of form over substance with this opportunity. It's still an important substance, but form was very important. The NYSE has a joint relationship with the Euronext. So by doing this, it was very efficient. The incremental cost was very low. So when we looked at the London Stock Exchange, for example, which was the other obvious choice, the administrative burden and the incremental cost to list on London far outweigh the incremental benefit that we thought we could achieve with going in Paris. Now, having said that, you know, if after a year being on the Paris exchange, it's not achieving everything that we hoped it would, we can still have an additional secondary listing in London as well. But that's a very, very good question, and we spent a lot of time on that.
Thank you.
Well, thank you very much. I appreciate the opportunity to be here.
Well, thanks a lot.
Thank you.
Bill, hang on a minute. On behalf of our alumni board, I want to present you with this glass sculpture in red and black by a local artist, Loretta Eby.
Thank you.
Thank you very much, Bill.
Appreciate it.